Okay, let's kick things off. Okay, my name's Brad Gilbert and welcome to the Forex Trading Made Simple presentation. Now, the whole basis of this is to give you some bit more understanding around the simple trading principles that you need to follow. Now, my experience, I started at Citibank back in 1990, would you believe, back in Sydney, and I was moved on to London about 95, over to New York in 99. Then I was back in Sydney in the 2000s to head up the Commonwealth Bank team, and then also ran the Asian trading desk for TD Securities. So I've got a fair amount of experience in this area to sort of give you a bit of advice and a bit more understanding. So coming back to yourselves, okay, you're either new to FX trading, an experienced FX trader and looking for a refresh, or keen but you just don't have any time. But the key focus, this is for everyone. This is our current members. This is people who have been looking at this for a long time and asking themselves the question, should I do this? Well, the answer is, if you want to make money, yeah, definitely. Okay, that's the key aim to it. But one of the key things is there's so many strategies out there. I mean, and there's so many different things happening in the market. What we're trying to do is isolate the best trading opportunities. Okay, and if you can get that understanding and capital management under your belt, well, then you're going to have a fair chance of becoming a successful trader. But what you're doing is you're rolling around with the market and the dynamic nature of the market. But what we predominantly try and show you is the strategies the bankers use, so you can get an understanding, get some structure around your trade plan and your capital management, most importantly, and then attack the market from there. All right, but the general plan is very simple. Okay, buy low, sell high. Right? Sounds easy. It can be a little bit difficult once you get going if you don't find those key entry levels. And what we're looking for with the key entry levels, whether it's through technical analysis, through economic data, or central bank announcements and these sorts of things, we're trying to isolate the low risk, high probability trading opportunities. Now, these opportunities aren't in the market every day. What you have to do is you have to be patient to wait for them. And some of these times is when you're at work and you actually miss some of them, and that can be quite frustrating. But sitting in front of the computers all day can be quite detrimental. You need to be fresh in front of the computer to analyze and make trading decisions. If you've been sitting in front of the computer all day, you could actually, miss something that's happening in front of you just because you're too close to see the action. Now, the simple trading strategies. What we're looking for is you need a full toolkit of strategies. Whether you're looking at simple trend lines, whether you're looking at economic data, whether you're looking at Fibonacci's, whether you're looking to scalp the market, there's a whole range of strategies you can use, but you need to have a basket of strategies because the market is different at different times of the day and different times of the week, different times of the month. So having a toolkit of strategies will enable you to take advantage of different market events and circumstances. It will definitely allow you to trade in all market conditions. Okay, so that's the key part to having a bunch of strategies. Looking at your basic technical strategies, your break trade, your range trade, your trend trade, and your false break trade. Well, yeah, they're your core structure, but what you need to do is specialize and look at the market in a particular way to take advantage of particular opportunities, whether they are coming from equity markets, whether they are coming from economic numbers, or central banks for that matter. Okay, so then once you have the plan in place, okay, it's about identifying and executing. You need to get clinical with this. You need to get very tough and discipline with yourself to make sure that you don't overtrade. And when you do see other opportunities, that you don't hesitate. Okay? See the opportunities, hit the market, and start trading. But one key thing that you need to understand, the market is dynamic, right? And that's once again why we do come back to having a basket of strategies and the basic technical strategies for that matter to attack the market and take advantage of these opportunities. All right, now strategies the bankers use, well, these are pretty simple. Intraday strategy, I mean, these are some of the key ones. Search and destroy, which is more around stop loss hunting. Snatch and grab, trading the economic numbers. The Ichiban strategy, more for the Asian session where you are looking to trade around the Ichimoku cloud. But most importantly, looking at those trend trading opportunities. Okay, and one of the key ones that we've been rolling out of late is the end of day strategy, which most traders should be looking at, especially the ones who have full-time jobs. And that is generally the predominant sort of market or clients that we have. They are working full-time, so you've got to be looking at these various aspects. But one of the key parts to getting this thing going is capital management, making sure you've got the capital management structure, okay, to start attacking the market. The market is aggressive. If you can't attack it with strong capital management, well, then you're sort of generally chasing your tail. And the majority of traders, I can tell you, who have no capital management, they generally fail. Okay, even if you have a little bit of success initially, what it leads to is bigger trading until you come unstuck, no stop loss, no capital management, and you're sort of on a hiding to nothing. Okay, so what capital management is about though, it's about preserving capital as well as capital growth, managing that capital growth as we go forward, and also managing those drawdowns. If you have ineffective risk management or capital management, then what you'll find is you'll slowly bleed your account dry. Okay, so looking at the capital management structure that we have, okay, capital at risk, okay, the standard approach, if you're looking to be a little bit conservative, you know, risking 1%. And what you should be looking at is making 3%. Okay, 5 winning trades equals 15% capital growth, right? So there's a good cash to be made. Now, what we predominantly look for in normal market trading conditions is a bit more of an aggressive approach, where we are risking around 2.5% of our capital. What we're looking for is 7.5% on a winning trade. Okay, now that sounds pretty aggressive, but if you do have good market conditions and good directional opportunities, then this is where you're going to make a lot of money very quickly. 5 winning trades in this situation, yeah, you could be up around 35, 37%, and it's that quick and simple. Now, obviously, it's much easier to make a bigger percentage when you have a smaller capital amount, but as you can see, you know, if you have one good trade a week, okay, well then you're going to be looking at well over up to 100% per annual return, right? And that's the sort of focus that you need to have as a professional trader. If you want to change your lifestyle and make a living as a professional, then this is what you need to get under your belt. All right, so, but let's just bring this back into reality. Now, I can throw up, you know, big percentages and all those sorts of things. Let's just have a look at the general structure with a $10,000 trading account, risking 2.5%. Okay, you're risking $250. Now, there's at least 50 fundamental opportunities each month. These are the economic data releases. These are the central bank announcements and all the mixture of fundamental releases that come out. Now, if you looked at just getting one per week, right, after 4 weeks, you're looking at 30% return. Okay, that's if you're a genius and you didn't have any losing trades. Now, that's not very realistic because you do expect to have a lot of losing trades in amongst the winning trades. It's your capital management, your risk to reward ratio, which keeps you focused and keeps your account turning over. So let's just have a look at this. So 10 losing trades. Now our simple capital management system is called the 4 consecutive loss rule. Okay, you have your first 4 losses, you would lose 10% of your capital. Okay, if you were trading very aggressively. But this is where the drawdowns come in very quickly. You half your trading size, your second 4 losses are 5%, your next 2 losses after that will be 1.25%. So all up, you're losing about 16.25%. But over the course of that month, okay, you've had 1 winning trade per week. After 4 weeks, you're up 30%. So even after a month, and this is more realistic, okay, your net trading result, of course, okay, 30 minus 16.25%, you should be looking at around 10% or more per month, and that's with a lot of losing trades in there as well. Okay, and this is where your trading structure comes from. It comes from your capital management. And even if you're having 10 losing trades a month and only 4 winning trades, with that risk reward ratio and capital management, you're looking at well over 100%. Okay, now this is good trading markets and good trading conditions. Now you get varying months where the market does discombobulate, where it does go a bit mixed. So then you may not have as many winning trades and you may not have as many losing trades. But what I want to sort of explain to you is with good capital management and consistent risk reward ratios, you should be looking for annual returns well over 100%. Now this is trading 2.5%. If you dial it down to 1% and you're making 3%, right? Well, then you're looking at sort of half of this or a little bit less. You still should be looking for well above 50% returns. Okay, and once again, once you have capital management under your belt, right, trading does become fun. You know, gone are the days of you chasing the market and chasing your tail. All of a sudden, you start trading with money you've made, and this is where you start relaxing, start to look, you change your lifestyle, and at all the hard work and all the effort that you've put in to get yourself into a good trading system pays off. Okay, and that's what it's all about. How much time do you need to commit to trading? Well, I would say 20 to 30 minutes a day. Right? What you're looking for is you're looking to analyze the market technically. Now, once you get efficient at that, that should take you 5 or 10 minutes. Then you can look across the board and see where potentially there's some momentum changing economic data releases or not. Okay? And you're looking to combine the direction that comes from the fundamentals with the entry levels that the technicals provide, and that's where the best trading opportunities are. Okay, and you're looking at 20, 30 minutes a day to allocate. It's not a lot of time to get into a good trading system and lifestyle. Of course, there's an educational process in amongst this. At the start, you'll be spending a bit more time looking at the markets or going through and getting that understanding. But once you do have the understanding, 20 to 30 minutes a day is all you need.